So up first, we have Duncan Craib from the Managing Director and CEO of Boss Energy with the ticker code BOE. I don't imagine that Boss needs much of an introduction. However, the company's flagship asset is its 100% owned Honeymoon uranium project in South Australia. To tell you more, I'm going to hand you over to Duncan.
Jane, thank you. Thanks very much for hosting today. And, it's a hard act to follow with Guy. He is arguably one of the most experienced and knowledgeable fund managers globally. So, yeah, really good comprehensive sort of opening that Guy gave. So just picking up on some of those key points that he made, really for us, we look at it that there's surging demand, there's limited supply, and is the uranium industry ready to support the expansion of global nuclear power? And as mentioned globally, not Australia, but globally, that nuclear power build out and expansion is taking place. Last week on May the 23rd, the President of the US signed 4 executive orders under the Defense Production Act to scale US nuclear energy to re-establish the US as a global leader in nuclear energy. Citibank phrased that executive order, or those 4 executive orders, as marking the most aggressive US nuclear policy act in decades. I mean, globally, this market is taking off. And if new production doesn't materialise in the near term, we're heading for a shortfall in the industry that can only be remedied by a rise in the commodity price to support new development. So when we look at price, if you look at the term price or the spot price, look at that as an incentive price, and it's simply not high enough to encourage new build-outs. So if you look in our ASX, DPLO, for example, Bannerman, are ready to go. They're waiting in the wings. They just need a higher price. And in the meanwhile, they're deferring their final investment decision or FID until it's raised. So prices have to lift to encourage that new development and also new exploration activities around the world. Over the past 6 months, as Guy pointed out, uranium prices fell to a low of around 63.5 US per pound due to uncertainty in the world, due to geopolitically global uncertainty, whether Russia and Ukraine, or what would the US administration do with regard to tariffs and sanctions. And what that found is that the nuclear fuel buyer or the utilities stepped back from the market. They've typically got about 1 to 2 years of inventory of their own supply, so they can withhold market shocks. You can't simply turn a nuclear power plant on or off. So they stepped back from the market, they stopped sort of contracting in those long-term contracts, and they waited for the dust to settle. And as Guy mentioned, I mean, now that these executive orders have come through and the expansion in the US that's going to take place and is taking place, US utilities are now coming out to procure more materials. Certainly, we're getting inbound interest as well from Europe, from China, South Korea, Japan. I mean, it's just the WNFM or World Nuclear Fuel Market Conference that Guy alluded to next week in Sydney is the first time in 51 years this preeminent conference has been held in Australia. And on Friday next week, we're hosting 30 fuel buyers up to the Honeymoon site. Such is the interest in Australian production, given its geopolitical stability and known as a good trading partner. So spot prices have now risen to 72 US per pound in recent weeks. But meanwhile, those term prices that we focus on at around 80 US a pound, they climbed over 21 consecutive months to December of last year and have maintained that steady position. So if you look at it both, 72 US per pound spot price, 80 US per pound term price, you're looking at some of the highest prices at the start of a new nuclear cycle. So it's really exciting, but still it's not high enough to incentivize that new production. So we feel that a price rise is inevitable. A spike will happen because of the shortfall in supply. So it's a very exciting time in the market. We're currently witnessing a revival of interest with significant midterm demand from utilities extending into, as Guy mentioned, from 2028 onwards. And Boss, well, we're in an enviable position because we're there right now. And I'll start sharing my screen, but essentially where we are with Boss is our flagship Honeymoon project is delivering and became net positive cash flow producing as we announced in the March quarter. So with spot prices, with the high quality register and spot prices rising, we feel our strategy to be ready at the start of a fuel cycle, we timed it just right. And we're very fortunate in that, but we took the leap of faith when the uranium price was hovering around 45 US per pound, believing it would go up, and fortuitously, it actually has. When you look at our shareholder returns over that journey since we acquired the project in December 2015, we've basically delivered an annualized return of 38.5% each year for the past 8 years. So it's been a terrific outcome, and it's really just walking aligned with the actual commodity price itself and the market demand. But the purpose of this slide, and I know it's a busy slide, but it's to highlight the challenges and sort of milestones new projects need to wade through, and it's not easy. You've got to look at the jurisdiction. Do you have the right people? Do you have favourable government supporting uranium mining? All of these factors play an important part. But really, what we did with the low uranium prices is we walked with the market. When prices rose and it was reflected in the share price, we did raise capital. Over the journey, we've raised 430 million. But of that, we still have liquid assets on the balance sheet of around 250 million. And we've got Honeymoon back into production and a 30% stake in the Alta Mesa mine managed by Encore Energy in South Texas. When we look at Boss now, if you took a snapshot, really, we've got a lot of cash, liquid assets, primarily being inventory held in the Confidine conversion facility in the US. And we basically have there's zero debt, and we've got that net positive cash flow. So Honeymoon's wiping its face, paying for itself. We're on guidance. We will hit our production guidance of 850,000 pounds by June this year, end of next month. And really what that shows, it's quite remarkable really for any mining operation to achieve its targets within the first year. So never once have we actually changed our CapEx forecast or our feasibility forecast or our cost profile since we did the feasibility study and released that back in June 2021. Really, plant infrastructure, we're building out our well fields. The NIM6 circuit, which is our ion exchange circuit, is working very well. And we're also looking at expansion, whether that's organic through our own exploration or inorganic, I should say, through mergers and acquisitions. But we're being very disciplined with that capital allocation, really looking for value accretive type acquisitions. Looking at sort of more in a sort of diagrammatically, Boss Energy is the only multi-mine producer listed on the ASX currently in uranium. So as mentioned, we've got the 100% owned Honeymoon uranium project in South Australia. We believe South Australia is the premier uranium state in Australia. It's got the only producing mines of uranium, being Olympic Dam, the Heathgate, and ourselves. So no other states really producing uranium now. But that just shows it's got a very supportive government. Labor's currently in power in the state, but they are right behind uranium exploration and development and production. So we're shipping uranium, we're receiving cash for that, and we're selling internationally. We're focused on Europe and US as our target markets for selling pounds, and we can look to expand that further as we ramp up our production at Honeymoon. Over the pond, really, in South Texas, we've got a 30% ownership at asset level, so at the mine level, not the topco, of Encore Energy's managed mine. It's a terrific project, arguably the best ISR project in North America, and a really terrific team involved there. And they had a bit of a rocky start with their startup. It's not unusual to have ramp-up problems, but they're on top of that now and they're dealing with it. And essentially, as Guy alluded to, you know, it's a good example where they went into contracts very early in the cycle, and with the production not keeping up, they were forced to sort of borrow or buy pounds to feed into those contracts. But they are now looking after themselves. They're producing their own pounds to feed into their own contracts. In return for our 30% ownership, we get 30% of their production. So with that, we can sell into our own sales book unencumbered, and we can feed it with our other production coming from Honeymoon. We've also got a pipeline of growth opportunities, and really around the Honeymoon mine in South Australia, we've got 2 satellite deposits known as Jason's and Gould's Dam. Collectively, that's 36 million pounds of JORC resource. We've recently finished at the end of last year an infill drill program on both of those deposits. That data sets with independent geologists now, devising a sort of block model and economic feasibility to see how viable those assets are to bring into production. But that's our near-term production. Around that area from Honeymoon to Gould's, Jason's, there's also a number of uranium hits that we've had on our tenements. So we're progressing those with arguably a very, very strong exploration team of 8 geologists, all of whom have got experience in uranium exploration. So we're continuing to generate exploration targets, but we've also looked further afield, and recently we entered into a staged earn-in agreement with Eclipse Metals, looking at one of their tenements in the Northern Territory, called near the sort of Alligator Rivers uranium field, so quite close to DevEx and Alligator Energy in that sort of zone. But it's ground that Cameco previously held from 2006 to 2008. And working with us in our team is a lady called Penny Sinclair, who was Cameco's lead exploration geologist in Australia in the life cycle. So she's familiar with the ground. We thought we'd go do a staged earn-in, which basically means if it proves to be worthwhile, we'll go to the next step, having done desktop due diligence to actually detailed exploration and drilling. But it requires deep pockets, and we've got to be really careful with the Northern Territory. But it is what we call sort of elephant country. We think that's where the big unknown deposits remain in Australia. Looking across to Queensland, and I'm thrilled to be a shareholder now of Laramide Resources. We sort of in a savvy way, and sort of over a period of time, we've acquired a position up to 19.7% of that project, with Westmoreland being their flagship asset. Westmoreland's in Queensland. Terrific asset, about 66 million pounds JORC resource. There's room to expand upon it, and we honestly believe that is the best undeveloped uranium project in Australia. We know that the Queensland government's currently got a moratorium on banning uranium mining. However, the current Premier, Christopher Foley, was previously the Minister of Mines when the Liberals were last in power, and he lifted the moratorium. So what he's basically said is if there's a credible party with the right resource behind them and financial backing, then they would consider it. So we believe with BOS and our credentials with Honeymoon puts us in a good position. But in addition to that, Laramide's got projects in New Mexico, which also work with Encore Energy in that regard, and also some exploration targets in Kazakhstan. Honeymoon itself, and just to sort of emphasize how hard it is to bring uranium mines into production, it takes time. I mean, Honeymoon itself takes 50 years to get into commercial production. And really from the early discoveries in the 1970s to there, you can see the backyard swimming pool, basically, where they were trialing in situ recovery, which has only been really around in uranium for the last 40, 50 years, to David Brunt there, who's still with us in his red flares with in situ recovery. But really, the purpose of this slide is to demonstrate it's not like gold projects or coal projects or iron ore projects that can come on quickly. It goes back to, do you have the right people? Are you in the right jurisdiction? Does the resource stack up? Do you have a political stable support? Because it's all those very important sort of qualitative factors that count so much to get uranium mines up and running. And hence, you're not seeing them frequently come online. Where we are, we're really, just to re-emphasise, we're on track to deliver our guidance, £850,000, ramping that up next year to 1.6 million, and then on to the 2.4 nameplate production. We've got just on the March quarter alone, shows a run rate annualised now of £1.2 million. So our NIM6 column 3 is ramped up, 1 and 2 are operating at nameplate, and we've currently got construction of the next 3 columns underway, and they'll be completed by the end of June. Commercial production was declared on the 1st of January, and by the March quarter, we were declaring our net positive cash flow, which is a terrific outcome. Our cost guidance is really pleasing too. So in our feasibility study of 4 years ago, we estimated a sort of C1 cash cost of around 18.6 US per pound. And here we are 4 years later with all the inflation that we've incurred since COVID, and still getting around 21 to 25 US a pound. So if you go back to spot prices at 72, term prices at 80, to have those sorts of C1 costs makes this a very profitable project. So, we're continuing to drill, we're continuing to explore, and we're going to update the market in the coming quarter with our mineral resource update for Goulds and Jasons and how that can feed into the production profile. And they're just in a bar graph, really just showing the growth. And in the orange bars, you can see the sort of drummed uranium and how that's been picking up. So, almost quarter by quarter, it's doubling, and it just is testament to the plant working optimally, having adopted ion exchange as the process technology that we're using. In terms of just pictorially looking at the columns itself, they're the first 3 columns, 1 to 3, left to right, and now you've got 4, 5, and 6 being built. That's a photo taken 3 weeks ago, and we're now at the top level, similar to what's in the background. So yeah, construction's going really well, and that big yellow crane sadly is coming to the end of its useful period that we need it for. But we actually built this project self-performed. So we didn't go out to EPCM, pay the additional 30% premium. We actually employed our own Australian engineers, our own Australian construction workforce, and we've built it really with most of the products coming from Australia. In fact, 95% of our expenditure is Australian domiciled expenditure. It's only the resin beads that we import. So very much a proud Australian development. Looking at wellfields and what we're doing, if you can see the sort of blue outline, that's the box mining lease that we're in. That mining lease hosts 36 million pounds. So in addition to that, the satellite deposits hold 36 million pounds. So collectively, you're looking at a 72 million pound resource potential. The 3 domains that we call it in our sort of geology perspective, we're focusing right now on the centre Honeymoon domain, but then we're branching out to build wellfields in East Kalkaroo as the second domain, and then Brooks Dam as the third domain. So a lot of wellfield activities taking place, but essentially they just keep rolling out, and we stay about 6 to 12 months ahead of schedule in terms of wellfield development. So right now we've got clear line of sight for the next 18 months with known wellfields sitting over known resource, which is terrific. So it's really now we just manage ourselves with the commodity price. I've talked about exploration, so I won't spend too long, but just to show you on a map, Honeymoon mine is situated here, about 15 kilometres to the north is Jason's deposit, and then about 80 kilometres to the sort of northwest is Gould's Dam. We've also got some tenements to the south that we call the Kinloch properties, and we're actively exploring there. So these deposits really do have that potential to drive the company forward, to increase the actual production, annualised production up to 3.3 million pounds, which is our federal government endorsed export permit, or extend the life of mine, or a combination of both. In terms of Alta Mesa, our plant in South Texas that we own 30% of, there's a picture of it, and it's different. It's an alkaline solution rather than what we use with acid, but very effective, and that plant's running very well. Where they got caught up was not developing wellfields quick enough, but they've addressed that issue. They've now got 22 drill rigs on site and actively speeding up the wellfield deployment. Looking at them, we had the official opening with President Bush in October. Their first 2 ion exchange circuits are now up and running, and their wellfield solution head grades are coming in very respectably at about 65 to 140 ppm, or parts per million, of uranium, which is very, it's very respectable within the industry. They've captured about 50,000 pounds in the March quarter, of which we get 30% to sell into our own sales mix. And they're now really ramping up to that production name rate of 1.5 million pounds. So once they are at that level, we get sort of 30% of that, 450,000 pounds on an annualized basis in the US, where US production only accounts for 5% currently of US's demand, let alone with the executive orders and further growth in that nation. So yeah, wonderful to be partnering with a US production producer. So I'll just touch on market update. I know Guy covered this quite extensively, but I think when you look at it, this dotted green line really shows where the term price is and the spot price. And what's fascinating is that the term price actually recently with the exchange rates are the highest in Australian dollars it's ever been in the history of uranium. So wonderful opportunity for an Australian and US producer coming onto the market. The orange line represents the spot price, and you can see occasionally it shoots up higher than the term price. When it goes too quickly, you find that the term price lags by about 3 or 6 months. If it goes too quickly, fuel buyers typically step back and wait for it to calm down because they can rely on their own inventory balances. But meanwhile, as the spot price continues to rise, the lagging term price follows. And, to stay at 80 US per pound is quite something over the past sort of 6 months. So very, very exciting. It's exciting that uranium's exempt from US tariffs, and the US is really pushing the nuclear debate now, and expansion of conversion facilities and enrichment. And really that's bodes so well for a geopolitically stable producer such as Honeymoon in South Australia. So Jane, with that, I'll finish up, and happy to take any Q&A if you like.
Yeah, absolutely. And Duncan, it is great to see that Boss is on track to deliver that production and guidance at Honeymoon. So we will jump into some questions. And again, webinar attendees, please use the Q&A function, which can be found at the bottom of your screen. We are running over, but I'm going to jump into it. So the first one looks a bit educational. So regarding Honeymoon, and again, well done on achieving commercial production, can you walk us through some of the key technical or operational decisions that were most crucial in achieving this milestone? So maybe perhaps for some that are not so across how production works compared to other commodities, just give us a bit of an example there.
Sure, sure. So Honeymoon is a restart project. It previously operated, produced, sold uranium around the world. But when we acquired the project, the uranium price was around 18 US per pound. So it was very low on the back of Fukushima, and the plant simply wasn't economically viable to run at that point. So we then did a detailed assessment of the project, and what they were using in their processing plant was a method called solvent extraction. What we changed it to was ion exchange. So we basically simplified the processing circuit to make it more efficient and cost effective to produce uranium. So introducing ion exchange was the key driver for our technical advancement. We did that with ANSTO, Australian Nuclear Science Technology Organisation. We did it with local consultants, and worldwide we had independent experts advise us. But that definitely has lowered the operating costs and increased our production throughput. In addition, we looked at our well field. So we, with more modern drilling and techniques, we're able to, and picking up off what Kazakhstan was doing, Kazakhstan really became prominent in the last cycle with their in situ recovery. So after the original Honeymoon was built, but really we adopted new well field strategies. So better placing of the screens under the ground, changing the actual excipient, which is the fluid, which sort of leaches the uranium. So we increased the level of acid. We introduced ferric as an oxidant, and the combination of that with our groundwater supply works very well. So yeah, it was largely looking at the well field, changing the plant design, and also just getting the right people on board.
Yeah, absolutely. Look, a couple of questions here just about the pricing of uranium. So just regarding the uranium market, how are you thinking about contract pricing versus the spot market? So perhaps maybe just a bit of a summary on the market itself.
Yeah, we've been really disciplined in contracting. We didn't want to rush our contracting. We believe that fundamentally the uranium price has to go up to incentivize new projects to come online. So it's similar to what Guy was mentioning. It doesn't make sense for new producers really to contract their whole book or their project right up front. I mean, where's the blue sky with that approach? So what we've done, we've contracted about 3.5 million pounds, roughly 17% life of mine, predominantly in these early years, so 25, 26, 27. And we will keep contracting, but we're going to be very disciplined about it. When we enter into contracts, typically they're a hybrid contract. There's a level of fixed pricing. There's a component of market-related pricing with a floor and a ceiling. And so that's typically how we're going to go forward. More recently, what we've been doing is sort of carry trades, really selling 3 months or 6 months in advance. For example, when the price was around 65 US a pound, we were able to forward sell 6 months in advance at 69 US a pound. So what that does, it allows us to keep being sustainable and a going concern, but it doesn't bind you up for 5 years into a contract. So it's just a more savvy way. We're nimble and we can be quick. It's not like Cameco, for example, that has 20 million pounds to find homes for each year. They have to contract. But we can use the spot market to our advantage with that carry trade, only selling to utilities, and it seems to be working for us.
Duncan, look, and there's a couple of questions, in fact, actually, that came through before today's presentation, just about Boss's portfolio, so assets, growth options, which I know you've gone into a little bit today, but I might just ask more broadly, whether it's South Australia, the Northern Territory, the United States, or even Kazakhstan, with your experience, which do you see offering the next best sort of opportunity to come into the market?
I honestly, if we had the right government policy, Australia, we've got a third of the world's resources, Western Australia, Northern Territory, Queensland, for example, wonderful resources, wonderful opportunities. So I really think Australia, if it could lift or change the political environment in which we operate, would be amazing. But from our purpose, what we and our shareholders are really focused on is to be a stable Western producer. So by that, we're really focusing ourselves on M&A activity or growth within Australia, North America, and Canada. That's our target market. There's wonderful projects around the world, not discounting that, but that's where we are currently positioning ourselves in those countries.
Duncan, I think we've gone over time here at the moment, but if we've missed any questions for Duncan, please feel free to reach out via info@janemorganmanagement.com.au. But Duncan, I really appreciate your time.
Thank you. Thanks very much, Jane. Thank you.